All right, so we're going to have probably a couple of videos now about Treasury stock. And so this is in our discussion of stockholders' equity as it pertains to paid-in capital, payment of dividends, equity financing, etc. So let's try to define what Treasury stock is, and this multiple choice question here will help us do that. It says Treasury stock shares are shares held by the U.S. Treasury Department, part of the total outstanding shares but not part of the total issued shares of a corporation. Choice C, unissued shares that are held by the treasurer of the corporation, and D, issued shares that have been reacquired by the corporation. Okay, so let's start with choice A. This is one of those answers that if you didn't study for the test and you're just really not sure what to do, you might pick that one. So they're trying to trick you with Treasury and U.S. Treasury Department. These have nothing to do with each other whatsoever. B, we've got some information that is reversed here. So Treasury stocks are not part of the outstanding shares, but they are a part of the issued shares. Now we're going to come back to that one here in a minute. C is also wrong, unissued shares held by the treasurer of the corporation. D, it says shares that have been issued or issued shares that have been reacquired. So I want you to understand the only reason that this is a problem here is because once the corporation, it says a corporation. Let's change this in the answer to say the corporation, because I want it to be clear that we're talking about the corporation that issued the stock in the first place. So I'm actually going to erase this and put it above. Okay. So we issued the shares, but when we reacquire them, they're no longer outstanding. Okay, so D is the answer, and then up here in B, the information in B is backwards. They're not outstanding, but they are part of the issued shares. All right, so the cost method of accounting for the purchase and sale of Treasury stock is a commonly used method. There are two methods, the cost method and the par method, and the cost method is in fact the more common of those two methods. Next true-false question says Treasury stock is listed in the stockholders' equity section on the balance sheet. This is a true statement, but I want you to understand that Treasury stock is a contra equity account. So if I were to make the statement, think about our assets, for example. If I were to say that accumulated depreciation is listed in the property, plant, and equipment section of the balance sheet, that is a true story. It is. It is not an asset, it's a contra asset account. If I were to say discount or premium on bonds payable is listed in the long-term liability section of the balance sheet, that's also a true statement, even though they are not, neither one of those is an actual liability, right? They affect the carrying amount. So what we are talking about here with Treasury stock is and we'll get to this pretty soon, but Treasury stock is basically a form of adjustment to stockholders' equity. Okay, so that is where it's going to be. And I think we might have something here. It says the cost of Treasury stock is deducted from total paid-in capital and retained earnings in determining total stockholders' equity. Okay, well, let me say this. we set up in this question that Treasury stock is an adjustment account, and it is basically a deduction from paid-in capital. Okay, so the first part of this question here is correct. But when we start talking about retained earnings in determining total stockholders' equity, this part is not true. So Treasury stock, the cost of Treasury stock, does not impact retained earnings. What we are going to do is we're going to merely impact paid-in capital. So if we had let's just say $100,000 in stock that was outstanding, and we repurchased $10,000 of that stock as a corporation, well, now we only have $90,000 total paid-in capital outstanding. But our retained earnings comes initially from the income statement and then flows into the statement of retained earnings and then ultimately into the balance sheet. But that has nothing to do with owner investment. So this is going to be a false statement. All right, so let's see what we have going on here. Looks like we might need our calculator. So we'll bring that over. It says on January 1, Vermont Corporation had 40,000 shares of $10 par value common stock issued and outstanding. All 40,000 shares had been issued in a prior period at $20 per share. So on February 1st, Vermont Corporation is going to repurchase 3,750 shares of Treasury stock for $24 and later sell them for $21 per share on March 1st. So a lot of information. You can just about be guaranteed that you're not going to need all of it, especially the multiple choice question. It says here the journal entry to record the purchase of the Treasury shares on February the 1st would include a so. And then they want to know what we're going to need to answer this question. So all we're asking about is what we need to do to record the repurchase of these 3,750 shares at a price of $24. Okay. Well, what we're going to do, because we are using the cost method, and we don't have, I guess we do have some information about par. We're going to be answering this question based upon the cost method. And so what we're going to do is we're going to simply take 3,750. That's the number of shares here that were purchased by the corporation. And we're going to multiply that by the amount that we paid for them, which is $24 a share. And if we do that, it gives us 90,000. So right away we can eliminate choices C and D because they don't have anything to do with 90,000. The other issue with C and D is that we're talking about losses and gains. And so, number one, I guess the first thing we need to acknowledge is that there are no gains or losses on Treasury stock transactions. Okay? But even if there were, all we've done is purchase the Treasury stock. So we got the wrong amount and we have a loss and a gain. So now we have to look at choices A and B, and it says that we have a credit to Treasury stock for 90,000 and a debit to Treasury stock for 90,000. So one of those is going to be the right answer. Well, let's think about this. I'm going to try to move this out of the way a little bit. Let's go back up to this multiple choice question here. It says the cost of treasury stock is deducted from paid-in capital. Now, I want to focus on this part. And I told you a moment ago, I'll just put a little check mark here, that part is correct. So if we know paid-in capital, common stock, is going down here, well, what does that mean for us? Treasury stock, remember, treasury stock is basically an adjustment account. All right. So the number of shares issued is still the same, but with any type of adjustment account, the credit or debit will be the opposite of the account for which the account is a contra account. Well, that was not full, wasn't it? So if paid-in capital has a credit balance and we're using treasury stock as an adjustment account, then it must, or as a contra account, then it must be a debit to treasury stock. So treasury stock as a contra account would increase with a debit, even though common stock, paid-in capital, is going to increase with a credit. So our answer is going to be choice B. All right, so let's see what we have here. It says treasury stock that had been purchased for $5,600 last month was reissued this month for $8,500. The journal entry to record the reissuance would include a credit too. All right, so we've got a lot of stuff going on here. Let's just make sure we understand what's happening. We had a transaction for this $5,600 that was similar to this transaction up here. We debited treasury stock with this transaction for $5,600. We're using the cost method. So we know that we're going to have a credit to treasury stock. The problem is we can only credit it up to the amount that we paid for it originally. So when we look at these choices here, we've got choice A, a credit to treasury stock for $8,500. This is the wrong amount. We would not credit the full amount. We had $5,600. We can't go below zero. So that's going to be wrong. Let's look at choice B. It says paid-in capital from the sale of treasury stock. Well, I just told you that we are going to have a credit to treasury stock. So if that's the case, even if it was for $1, this choice would be impossible because we're wanting to credit paid-in capital from the sale of treasury stock for the full $8,500. So that's going to be wrong. Paid-in capital in excess of par, common stock. This is basically when we have when we issue stock, regular stock issue, and let's say that it's a $1 par, we would we would credit common stock for $1 per share, and then let's say that we sold it for $5, it would be $4. The remaining $4 would go to paid-in capital in excess of par. So this journal entry has no business in a treasury stock transaction. And then choice D, paid-in capital from the sale of treasury stock, $2,900. This is going to be our correct answer. And it just so happens that we have a little bit of room here at the bottom. So let's just see what's going on here. We sold this for $8,500, or let's see, where's $8,500, and then we got cash for that. So cash is going to be our one debit for $8,500. We had the treasury stock on the books for $5,600, and that is exactly how much we're going to take it off the books for. And then we're going to use this PIC account, PIC paid-in capital, from the sale of Treasury stock, $2,900. So again, D is our answer. All right, this video is getting a bit long, so we're going to make the Treasury stock conversation a two-part video, and we'll get started on that one next.